Hello and welcome back to another episode of Ticker Symbol Live, where we take a look at ARK Invest's 5-year vision of the future and where we map that vision onto the stocks they're buying today. Or actually, yesterday, because we're always looking one day back at their most recent trades and comparing that to their positions from beforehand. Today, I'd like to talk about LendingClub. So first, let's fire off the ARK reactor, and I'll show you what's been going on with their trades. So I have things in order of percent change in shares from the most recent 2 trading days. So looking at April 12th, their pre-market positions today, compared to 1 day before that, we see that Jaws Spitfire is at the top. That's Velo 3D, and we've already recently done a video on that. And number 2 with a 5% change is LendingClub, the company we'll be talking about today. Just as a quick reminder, what we do every day here is we try to look at their biggest recent position changes. So if I look at the change in their highest conviction positions, we can see that, it's been DocuSign, there's a little bit of green in 10x Genomics, and then we've kind of covered many of the stocks that they have been buying in large amounts, or at least relatively large amounts. And so when we start running out of their highest conviction positions, because we're doing a good job covering them, what I like to do is I'll switch to the change in shares held instead of the changes in their biggest positions, and we'll just go down that list, right? So this ARK reactor is our data discovery tool to say, hey, there's a few different metrics we care about in terms of ARK's largest conviction positions or the biggest changes in positions, what have you, and we can always find a new stock to talk about. So that's how we landed on LendingClub today. LendingClub sits in ARKF, ARK Invest fund themed around the Fintech revolution, so finance technology, and it sits in ARKW, ARK Invest fund themed around artificial intelligence and the next generation of internet applications. And those funds tend to overlap a lot because the future of banking is online banking. So while we're talking about the future, let me switch over to the browser and let's get into LendingClub. Stop sharing my screen here and start sharing my browser. So the first thing I always like to do when I'm thinking about the future, advanced technology, and what I think ARK Invest's vision of the future is and how they're mapping that onto the market today is I like to look at their clusters of innovation platforms. And this can be found in many of their white papers, especially their white papers focused on their investment methodology and how they choose companies and why they're focused on exclusively disruptive innovation. And what you get is a plot of their 5 big innovation platforms: blockchain, DNA sequencing, artificial intelligence, energy storage, and robotics. And then all of the innovative technologies that are springing up around combinations of those platforms, right? So the Internet of Things, mobile connected devices, artificial intelligence, and the blockchain, which we won't talk about today, are all contributing to what's called frictionless value transfer. And this is where LendingClub really enters the picture. The idea of banking today is filled with friction, and we don't always see it, in the actual banking process, but we tend to always feel it in our wallets. For example, high credit card fees, associated fees for banks, minimum fees for accounts, over withdrawal fees, or, not maintaining a minimum balance. All these different fees that are associated with banks because they have high costs due to the types of things they need to maintain within their institution, right? So the physical buildings in the best part of town cost a lot of money to maintain month over month, year over year. And those costs are passed on to their customers in terms of different fee structures, in terms of different interest rates, in terms of different loan amounts and criteria and all those things. And that's the area that LendingClub and companies like LendingClub are starting to disrupt. They're moving towards a model of frictionless value transfer, right? And so how they're doing that in LendingClub's case is they're matching borrowers and investors. So they are a peer-to-peer lending marketplace, a banking end-to-end marketplace solution that is reducing friction by having lending go peer-to-peer. And of course, LendingClub provides the infrastructure to that. We'll see that they've made an acquisition that makes them a full-spectrum banking marketplace solution. But the point here is they are flipping the marketplace, the banking model on its head to a marketplace model. And so how LendingClub works very quickly is you can apply in minutes as opposed to a traditional bank loan that takes a long time. You choose a loan officer and the best loan criteria for the type of things you're trying to do with that money. And then LendingClub matches you with a lender so that you can get funded, and then you're linked with a creditor, right? So this really cool system allows you to go from waiting 2 to 3 months to on the order of days to acquire a loan. And the types of loans they deal with are personal loans, so up to $40,000 at a low fixed rate, business loans, so up to $500,000, auto refinancing, so specifically for big purchases, in this case, your car. But you can imagine in the future they could add something for home refinancing or commercial real estate refinancing. You can imagine how they can expand horizontally, is what I'm saying. And then patient solutions. So one thing I just want to call out is specifically for medical types of loans, right? So loans for medical procedures and all that, which are another expensive thing people borrow money for. And a place where you want to reduce friction, because friction and stress when it comes to medical stuff is the worst. So imagine being able to corner a market, for example, acquiring loans for medical purposes, because you're the easiest, most stress-free way to do that. And part of becoming easy and stress-free is offering good cost structures. So let's talk about how LendingClub does that. This is a press release that I was just reading before this live stream, and it is LendingClub closing an acquisition of Radius Bancorp, and that's what I was just saying. The combination of LendingClub with a winning online bank creates the first full-spectrum marketplace bank. And marketplace bank is what I'm highlighting here because that's that new business model that LendingClub is going for to enable these frictionless peer-to-peer value transfers, aka loans between borrowers of LendingClub and investors of LendingClub. So what this combination is allowing is for access. What this allows for LendingClub, and sorry if you're hearing background noise, is access to stable deposits that reduces funding volatility over time, right? That recurring revenue that LendingClub is seeing by people paying off the loans that they have helped match is reducing the volatility on LendingClub's balance sheet. The low-cost deposits enable highly profitable recurring revenue growth. And remember, the reason they can afford these low-cost deposits is because they're not maintaining large bank branches, large infrastructures, large amounts of ATMs, all of those things that come with traditional banks. Their bank charter, now they have a bank charter, so remember, they can operate like a bank. They have all the powers of a bank, allows them to save on substantial fees paid to third parties because they can originate their own loans. So they can act as a bank even though they're a peer-to-peer lending marketplace. And that's big. They're combining the best of two financial worlds. Banking capabilities allow them to invest in consumer loans, better aligning their own interests with investors and driving marketplace efficiency. So they don't only make money when you lose money. They're trying to align those purposes, right? And then a capital light marketplace leverages technology and allows us to serve a broader spectrum of borrowers. So the 2 points I want to call out here: tech enables you to scale fast, which is great because it's not capitally intensive like building a bank branch, and they're moving into a broader spectrum of borrowers. Just like we talked about before, you can imagine them adding a house refinancing arm like they have for auto loans or medical, and now they're serving a big new customer base, people who are interested in refinancing their mortgages, which is a great thing to do right now. I'll put that in quotes just because the market bottom in terms of interest rates is currently happening and has been happening for a while. And the last thing I'll point out is nothing I say here should be taken as financial advice, both in terms of buying LendingClub stock and then running out and refinancing your mortgage. That's not what I'm suggesting you do. I'm simply pointing out that LendingClub could enter that market, and that makes them an attractive stock to me, right? So easy horizontal scaling. Excellent. So now that we understand a little bit about how LendingClub is structured, what LendingClub does, and the funds it sits in, let's go through their investor presentation. This is a slide already from their investor presentation, but it's on the bottom, and I feel it really captures the essence of why they're combining that marketplace model with the banking model, right? So starting from the top, here's LendingClub's investor presentation. Their highlights, they're a marketplace bank, right, that delivers the best of both worlds. I kind of just said that because I cheated and read this beforehand. Driving significant growth and profitability, again, by being a marketplace with banking capabilities. Best-in-class consumer lending platform, cycle-tested. That just means they've proven this model works time and time again at different scales with different types of investors and for different types of loans, from micro loans, personal loans, to business loans, to auto loans, to now medical loans. And hopefully we can see some mortgage loans in the future, because I think that's a big space. Embedded 3+ million loyal customer base with 50% repeat borrowers. I love seeing numbers like this. The people who lend with LendingClub and the people who borrow from lenders in LendingClub like the process enough to borrow again. And remember, lending sucks, right? And borrowing sucks. The loan process is tough, it's stressful, it's not easy. So when you see somebody like your solution enough to go for it again and again and again, it means you're taking something that traditionally isn't fun, or at least isn't easy. It's full of friction, and you're reducing that friction, reducing that stress, taking that process and making it palatable. So now you're giving people access to money where before they were like, this is too much for me, I can't handle it, right? And I've definitely felt that way before as a borrower, and certainly as a lender. You know, you let your friends borrow a substantial amount of money for something that they need, and there's always that stress between you of like, hey, how am I getting paid back? When? How much? All that. And so being able to have that taken care of for you in a frictionless way, because remember, this is peer-to-peer lending now, is excellent. Large total addressable market in one of the fastest growing areas in financial services, peer-to-peer lending. Meaningful advantages of a digital bank, right? So still digital banking. Enhanced resiliency, lower cost of capital, increased earnings, and that's all due to moving from a physical branching model to a digital technology model. And then the opportunity to unlock substantial shareholder value. So, over 3 million customers, over $60 billion in lifetime loan originations. Remember, they can originate their loans internally, so they're not paying all those third-party bank fees for originating loans. Their vision is to become America's financial health club, right? So I love that. Really empowering individuals to monitor their financial health, grab money when they need it, offload money when they don't, right? That's the two sides of the marketplace, being a lender or a lendee. And then their promise is to champion the financial success of our members with fairness, simplicity, and heart, right? And fairness and simplicity, you know, heart, I think we all get. We're all here because we believe in these companies' ethics, right? Hopefully you believe that. But fairness and simplicity, I think, are the real things that we all struggle with in the financial space today. Hey, I'm getting unfair loan terms. I'm being treated unfairly. The loan process is complicated, right? Think about all those qualms that you actually have with loans and realize that their promise is to alleviate that. The actual, hey, you should have no doubt that the terms of your loan are fair and that the acquisition of that loan is simple. So I love that these aren't really just some jargon generic words about their vision, you know, like, empower and blah, blah, blah. They're specific to the thing that they do. Fairness and simplicity, which are the two core concerns with borrowing money today. Always makes me feel good. So, cycle-tested leader, they have had since the 2020 earnings, sorry, I'm trying to get my words together. Their predictions into the future are a 23% compound annual growth rate based on their projections, right? So that's due to the amount and the amount of loans that they're originating, as well as the value amount of the loans they're originating. So not just the quantity of loans, but the amount of dollars of the loans they're originating. And they expect that to grow as more and more people find value in the peer-to-peer lending solution. They're positioned well as the market leader. All other digital lenders combined are less than 50% bigger than just LendingClub. So LendingClub has a significant portion of the market. Think about Roku's position in the OTT over the internet digital streaming market, right? Roku has an outsized position in that market, and they're a market leader and one of ARK Invest's biggest positions. As far as a pure play, peer-to-peer digital lending solution, LendingClub also is one of those big positions. It's not one of those huge ARKK positions because this is a tiny fraction of the total digital banking marketplace, but in its space, it's an outsized winner. That space being digital lending and peer-to-peer value transfer. So their members are high income, highly banked, credit-worthy Americans who love us for helping them improve their financial health, right? So high average FICO credit score, high average income, they average payment to income, so almost 10% of their income is handled through LendingClub, which is a pretty substantial number. They have a high net promoter score, higher than Starbucks, Apple, and Budweiser, right? And then the 35 is the average of financial services net promoter score, right? And we've covered why extensively on this channel. Dealing with financial services kind of sucks, right? Like, that's the thing I want to harp on here. Like, take a step back from the investing and just focus on you as a person having to go out and borrow money and interact with lenders today. That process is stressful. It's tough. It's full of friction in different areas. It's confusing. All those things that they want to address with fairness and simplicity, right? And as a result of doing so, they have a high net promoter score, right? So they've been able to take things that financial services often struggle with and alleviate those struggles. That's the thing I love to harp on here. It is tough to describe how easy this whole process was. I've always been intimidated by the nightmarish intrusiveness of the conventional loan process that LendingClub has just made disappear. So hopefully you're getting a feel for that net effect of moving to this model, right? Those 3 million members want to do more with them. I won't read all this to you because I know you can read and go check it out yourself. But the heart of this says that they're ramping up engagement per member, not just acquiring new members, right? So those are the two prongs of growth: acquiring new members and then engaging more with each member to get more customer lifetime value out of those members. But also, as a business, you're providing them more and more value over time through more and more loans, or however they choose to engage, more and more investments, more and more opportunities, and more core products. And significant data advantage, cough, cough, Tesla, right? So enables more offers at lower prices. So they use models to inform more than 148 billion cells of proprietary data and 2,000 plus attributes from 74 million repayment centers, over 3.6 million loans. And this is just a fancy way of saying, hey, we have a lot of data that we can use to finely tune how we match lenders and lendees, right? So people who are giving them money and people who are taking out loans, so that they can maximize the benefit to each person. And that data advantage results in a 20x lift over traditional credit scoring in predicting borrower charge-off risk and results in our industry-leading fraud loss rate, right? So basically, they're getting so good at matching lenders to lendees that their risk rate is lower, and they can offer better rates as a result of that process, resulting in lower risk, right? So this is obviously due to artificial intelligence and good matching services. One thing I always like to do when I think about these digitally enabled companies is think about the Netflix model. Netflix matches you to movies, right? And it's finely tailoring each movie through the thumbnail and through where it positions it on your screen and how it recommends it to you to get you to engage with that movie. You can imagine a financial version of Netflix that now isn't matching you to movies, but is matching you to lenders instead. That's not exactly what LendingClub tries to be, but you can imagine that as their algorithmic way of doing things. Hey, we have a bunch of movie viewers, aka people who want to borrow money, and we have a bunch of lenders, aka people who are willing to originate loans or fund loans that are originated through LendingClub. And now we're going to use AI and all the data we have to match them together to minimize the risk overall, right? Instead of maximize the viewing overall in the Netflix case, you're minimizing risk in the LendingClub case. So hopefully you can start thinking as some of these digital services matching companies like the Netflix of their space, right? Hopefully that makes sense. And so that results in a lot of advantages to LendingClub, and I think this is a great place to stop and then talk about their financials. So let me zoom in here because this is a very text-heavy screen. So they're able to efficiently serve a broad range of customers. They're capital light, they're a high return on equity marketplace. They're highly profitable because they have low maintenance fees compared to traditional banks. That allows them to lower the cost of deposit funding, and they're fully integrated end to end because they've acquired a few banks. That results in them being able to originate their own loans. They're digital first, so they have a small physical footprint and a large digital footprint like we just saw. That enables a vast data advantage from serving millions of personal loan customers that they can use to further refine that matching. They're unencumbered by high-cost branch networks and legacy systems. I called that out before reading that, actually. And then they have a strong growth trajectory because they can scale vertically, right? More engagement per customer, and horizontally, and horizontally by scaling to new types of loans. For example, imagine they scale into refinancing home mortgages. And that results in a recurring revenue stream because people are paying off their loans month by month. That means stable funding and clear and consistent regulatory framework, just saying, hey, they know exactly what they need to do to jump through all the financial hoops to keep being able to originate these loans and offer them in a peer-to-peer marketplace, not as a traditional bank. Right? So hopefully that gives you a sense of a lot of their advantages versus other fintechs and against other banks. So the goal here again is always to be combining the best of both worlds. Fintech solutions, digitally native, but can't always originate their own loans and take advantage of the great things that banks have, and banks who can do those things but pay for it in customer acquisition costs because of legacy infrastructure and large bank branch networks. So exactly where they have X's and checks is opposite of each other, and the LendingClub gets to take the best of both worlds as a marketplace that's digitally first, but can originate their own loans. Cool. And now we're back to this chart that we started on. So to wrap up, why don't we take a look at their quarterly financials and then answer any questions. Before we do that, let me ask the question of the day. The question of the day is, would you go through an entirely digital loan process? How do you feel about originating large dollar amount loans exclusively online? So without talking to a physical person, without ever meeting the person doing either the funding or the bank in the middle. Traditional, you walk into a bank and you try to get a loan. Obviously, a lot of that has moved online over time. So I'd love to understand your interest and your engagement. Have you ever gone through the entire loan process exclusively online, or do you still go into banks or into lending institutions or borrow money through a phone call or some other way that guarantees you some physical, real human interaction? I'd love to know where you think the human is required in the process, or if you think a human is required at all, or if it can be done entirely digitally. So let me know in the comments. Okay, let's wrap up. The quarterly expenses impacting adjusted net income losses. So sorry, we're in the middle of their financials. Let me back up here. So this is their quarter for 2020 results, right? Platform originations by funding source. So they get the funding for their, They get their funding for the loans from several different places. Institutional investors, banks, managed accounts, self-directed investors, or inventory that has been taken over by LendingClub itself, right? So in 2019, this is the mix of what that looked like, right? And in quarter four 2020, just 1 year later, we can see that there was a lot of growth in terms of managed accounts being responsible for that funding. LendingClub inventory, so the amount that LendingClub had to take over themselves, went way down. And then other institutional investors didn't invest at all in quarter three 2020, but have resumed investing in quarter four of 2020. So what that means is that product mix is getting healthier. There's a wider spread, and LendingClub has to take over less loans as a percentage of all their loans overall, right? great answers in the comments. So yes, I would use an entirely digital loan. That's awesome. I'm in that camp as well. I'm trusting these digitally native processes as much as I would their physical equivalents. How are they different from Square? Square is not a Square offers loans, but Square's does a lot more, right? They're a full digital ecosystem for banking. So they offer physical terminals for businesses. They are a full digital wallet for consumers. They offer a lot of software that enables those types of transactions. LendingClub is just for lending. Just imagine just that loans portion of Square, and now you're comparing apples to apples, and now they're still very different because of all the other things Square does. But we're just talking about lending and loans here. PKKFF, which is another stock I own, that's Peak Fintech. Peak Fintech matches lenders in China with vendors in China is how I like to think of them. So they're probably a B2B, business-to-business version of LendingClub, specifically in China, in Asia. So that's probably a little more on the nose in terms of apples-to-apples comparisons. LendingClub is U.S. only right now, I believe. And then we'll talk about loan originations and revenue, right? So quarterly loan originations, so quarter 4 2019 and quarter 1 2020, large amounts of loan originations, which look like, reductions to LendingClub as until those loans get paid back over time. So their quarter over quarter growth was negative 8%, negative 18%, negative 87%. So that's this bar moving down. And then they stabilized, right? In quarter 2, they hit the bottom just like everyone else did. And then they grew by 79%, 56%. And what you're looking at here is the number of personal loans originated that are standard, the number of custom loans that are originated, and then other, right? So you can see the number of loans went way down, and now they're on the uptrend again after the market bottom in 2020. And the quarterly total revenues, right, were really high in quarter 4 of 19. They had a big 31% drop in quarter 1 of 2020, a 77% drop in quarter 2 2020, right? This is year over year growth. And now those are starting to stabilize and move back up, right? As they look at their year over year growth from their previous quarters, obviously it being hit by the pandemic. So, and then they do things in terms of all these different loans that they originate, right? So what we can do is we can just go look at their earnings margins and all that. So their quarterly adjusted EBITDA, this is the slide I was really trying to get to. I apologize. So you can see exactly where they took the hit is exactly where you'd expect. And then they're on that uptrend again, right? So negative margins back when the pandemic hit, and then upward and onward from there. Let me take some comments here. I think everyone kind of understands the financial picture of these loans. They originate a lot of loans, so that's money out of pocket up front that gets paid back with interest with rates like interest rates over time. So they're making stable recurring revenue while they give up money up front in terms of loans. So let me turn it over to the questions here. I'm just going by what I'm seeing in the comments. Baby boomers show a little. I think the heart of this comment is it's if you are seeing better value as a baby boomer, it would be a little tough. But if you see a lot more value by going purely digital, you would do it. And I agree. I think that's the sentiment overall. There's a lot of novelty and a lot of new steps you have to learn in order to go fully digital on something like a loan, right? You used to think about it as just like, I'm going to go to my physical bank, I'm going to talk to a physical loan officer, and I'm going to do the paperwork and jump through all the hoops to get this loan in person, put on my suit, make sure they know I'm a person with a stable income, put my best foot forward, and do what I have to get this loan. Now, because that process is fully digital, it's more, it's more about the numbers. It's more about what type of person you're categorized as. You don't have to make that first impression physically. You are making that first impression by providing all the right information to actually de-risk the loan. So a big change from moving from physical to digital. I would I would if there was a reasonable degree of confidence of approval. Right. So this is great, right? Because now that confidence of approval comes from that de-risking system, that AI matching lenders and lendees by, risk profile and all of that stuff. And that drives down the risk. And what that means is more likelihood of approval if you are requesting a loan that should be mathematically approved because you can find a way to de-risk it. The first sector that will immediately start making money after COVID-19 era is the financial sector, in my opinion. I agree with this, but I think I might agree with it a little different than how you're saying it. I don't think people are going back to physical banking if that's the intent of this comment. I think people will realize how easy and frictionless certain online digital banking solutions are, and they're going to stick with them. And as a result of the pandemic, that growth will keep exponentially growing as people move their financial lives onto a fully digital platform, whether that's Square, whether some of it is managed by LendingClub, whether you're talking about overseas platforms, whether you're talking about doing everything through Apple or Amazon, right, using their wallets, Google Wallet, etc., or whether you're doing everything piecemeal. You have a digital bank, you have a digital wallet, you have a digital lending solution, etc., but now you're still online only. Great. And then I'll leave it on this comment. I think this is, now we're getting into the heart of AI, which is a little separate than what I'm thinking of here. Google says there are bots to help creditors fill requests, and the best loans go fast. So there must be some money in this. This is absolutely true. So financial institutions have to do a lot of paperwork. A lot of that paperwork is done over and over and over again. A lot of steps that are done over and over and over again are easy to automate. So what digital bots do is they can accept the most basic, most frequently asked questions and offer solutions and answers to those so that you don't need to bother a human to get answers to questions that have been answered hundreds of times before. And the next thing they can do is help fill out, you can imagine, 70% of the paperwork of a loan. So now you're having a human just fill in that 30%. So that's a drastic cost in the human capital required to execute or originate a loan, because now bots are just automatically chugging through and saying, oh, here, and here I can do, here, and here I need a human, right? And that's the core of fintech, taking a lot of the bloat out of that financial end-to-end system, right? Whether you're talking about physical branches moving on to digital branches, or whether you're talking about physical humans having to do physical paperwork, moving to bots and automated processes doing digital paperwork, and humans just filling in where they have to. So hopefully you can see how LendingClub, a peer-to-peer lending marketplace with banking capabilities such as loan origination, fits into that broader image of digitally enabled financial technologies changing the way we do finance today. I think that's a beautiful note to lead it on. Let me know in the comments below what you think about fully digital financial solutions. In this specific case, we're talking about fully digital loans, right? Accepting a loan fully digitally, or do you think you need to talk to a physical human, get a physical representative in person in a real bank branch? Is that your preferred method of acquiring money? Let me know. I think I'll leave it there. This is Ticker Symbol Live. Thank you for joining me on today's Market Open. My name is Alex, and I'm reminding you that the best investment you can make is in you. Thanks for watching.